We've all imagined what would happen if the entire globe adopted a single currency for all financial transactions. These feelings are amplified when we consider the exorbitant currency rates we face while traveling or transferring money overseas. These rates are astronomically expensive, and eliminating the many currencies might simplify the procedure for both us and the banking institutions. However, this reasoning is not unique, and we cannot conclude if adopting a single currency is simply beneficial or harmful. You can believe that life would be simpler if we didn't have to waste time when traveling, exchanging cash, or calculating conversions in our thoughts. The majority of countries have their own currency for a simple reason. Most countries have distinct economic conditions and seek to make monetary decisions that are tailored towards their own interests and demands. To comprehend these considerations, it's necessary to comprehend why currencies have different values and how those values change over time. Let's say in the United States, a Snickers bar could cost $1, while in Indonesia, it might cost over 14,000 rupiahs. Does this imply that a chocolate bar in Indonesia is 14,000 times the price in the United States? Well, no. When you change rupiah to US dollars, the price is nearly the exact same. Countries frequently peg their currencies to ensure the currency stability for investors who don't want to worry about currency value changes. If the value of a currency falls, the value of the investment falls as well. However, most exchange rates aren't fixed. They're floating, which means that their values fluctuate based on a variety of economic variables. One US dollar is now worth around 72 Indian rupees as of March of 2021. A dollar was worth 50 rupees 10 years ago, and to obtain $1 40 years ago, you only required 8 rupees. The value of a rupee has fallen over time, making it less valuable. A currency that appreciates is sometimes regarded as weakening because it can buy less foreign cash. Currencies, like other things, are purchased and traded. The majority of these transactions take place on foreign exchange markets or marketplaces for swapping currencies. Currencies gain value when a large number of people want to purchase them, indicating a high demand, and they lose value when fewer people want to buy them, indicating a low demand. The value of a currency will fall if there is a great lot of it laying about in the market, just as it would rise if there isn't much of it. As you'll see below, a currency's supply and demand could fluctuate depending on a variety of variables, such as countries' attractiveness to investors, commodity prices, and inflation. So who determines the value of a currency? It's quite simple for a few countries. They choose a widely used currency, generally the US dollar or the euro, and peg their own currency exchange rate to that currency. Belize's central bank, for example, determined that its currency would be worth half a dollar. As good as it sounds, usage of universal currency comes with certain benefits, and we could go on and on and on about these advantages of implementing a global single currency market. There are a lot of details to evaluate, and it may take a bit of time, but the rewards are undeniable. One of the key advantages is that it helps with the currency conversion expenses. One of the most upsetting aspects of converting one currency for another is the additional cost that is charged. Banks are often the ones that do the job for you, and that's why they charge a fee. When you wish to send money abroad, the same thing happens. It's possible that you'll have to pay the same amount for transferring as you are spending. In this situation, a single currency market would be an ideal option, as it would solve the primary issue. It would be far more preferable while traveling on any other activity that requires international payments. The single currency market provides us with the ideal opportunity to put our money to greater use. The extra money we calculated for the additional costs will be saved and not wasted once the currency conversion fees are reduced. The first notable example in this instance is the creation of the European Union, whose principal goal was to enhance European nations' economic dependence, which will have a spillover effect and lead to stable political environments. In 1999, the single currency market was implemented. It assisted the nations in saving between 13 and 20 billion euros that would have been paid as a charge for exchange had the economic connections been fully operational. Different exchange rates were one of the principal barriers to open and effective commerce, preventing the free movement of goods. Because there will be no additional tariffs, the single currency will have direct positive influence on importing and exporting products. This is the primary reason why the European Economic and Monetary Union was established in 1992, and the use of a unified currency boosted trade efficiency and convenience. However, that's not all of it. Having a universal currency comes with its own disadvantages that could affect the global economy significantly. One of them is the fact that various countries have distinct economic circumstances. One international currency necessitates the establishment of an institution, such as the central bank, with the ability to produce currency and set interest rates. However, the truth remains that economic situations differ from country to country. The policy implemented by the central bank should be neutral, with no bias for one region over another. While living conditions differ significantly among countries, the approach would not be more efficient than the existing one. Another issue is financial independence. One of the most significant disadvantages of the one currency world is the loss of financial liberty. The government will have to abandon a practice that benefits them greatly. China serves as an excellent illustration of this. China's enormous economy is causing its currency to depreciate as it exports more items than it imports. The fundamental reason for this is that fewer dollars can purchase more Chinese money, thus consumers are more inclined to want to buy less costly goods. Devaluation of money is accompanied by raising the country's money supply. When there is a greater supply, the value of each paper falls, which can be produced by printing more money or lowering interest rates. China would not have the authority to implement the same policies in a world with a unified currency. Finally, it will result in an economic downturn. The single currency market, however beneficial it may be, causes challenges for forex trading and currency speculation. Most traders and investors have always been drawn to the financial market because of the absence of transaction costs. These incentives are more likely to be offered when exchange rates allow corporations to make considerable profits. Nevertheless, the brokers exploit these benefits for other purposes. Companies acquire benefits over time and benefit from fluctuation in currency exchange rates, which would not be allowed after the introduction of the single currency market, which might lead to a financial catastrophe. When it comes to the necessity for neutral central bank measures, certain nations will still benefit more than others. Germany and the European Union are the greatest examples. Even before joining the EU, Germany had a robust economy, yet German products for other European nations were not as appealing. German exports were highly enticing after the adoption of the euro, which was a more depreciated currency than the old Dutch mark. This is why the German economy has performed much better than in previous years. Other nations, particularly in southeastern Europe, were unable to lower their currencies to make their products more appealing, resulting in a drop in exports and rising indebtedness. When there are significant benefits to creating the single currency market, the opposing arguments are as legitimate. While both proponents and opponents of a single global currency have convincing arguments, there may be a middle ground of options. Nobel laureate Robert Mundell established the concept of optimum currency areas in 1961, which encompassed areas where national currencies were closely linked. He used Europe as an example, which did not use the euro at the time. These ideal currency zones appear to be a forerunner to the present currency system in use throughout the region. As a result, his concept of optimum currency areas may still be valid. We may have collectives of nations in comparable stages of development and geographical proximity pursuing common monetary goals, akin to the European Union. Instead of a single currency, we may have a few different currencies. The special drawing right, the IMF's global reserve asset, is just that. The US dollar, euro, Chinese renminbi, Japanese yen, and pound sterling now make up the SDR. These are the currencies of some of the world's most resilient economies. To eliminate many of the accompanying conversion expenses, the SDR or something similar may be utilized more frequently as a store of value in cross-border transactions. Another potential is the world's dollarization or eurozation, in which nations choose to accept the US dollar or the euro as their national currency, thereby converting an existing currency into a global currency. Finally, we must keep the possibility in mind that the optimal currency system for the global economy may be a wholly fresh stroke of genius yet to be offered.